Look, the big tax cut of 2017. Remember, it was supposed to pay for itself. That was how it was sold. And generate vast economic growth. Instead, it added $2 trillion to the deficit. It was a huge windfall for corporate America and those at the very top.
Them's fighting words. President Biden taking a shot at the Trump tax cuts. This, of course, last night, too, is addressed to Congress, saying it actually only benefited the 1%. Now, his tax plans call to ramp up penalties on the rich and to keep the free money flowing. Wall Street loves the sales pitch because, well, let's face it, Wall Street loves free money, but there are always strings attached and there are always consequences. On that, I'm going to bring in my friend Larry Kudlow to discuss. And Larry, let's face it, President Biden took a direct shot at President Trump, and you were one of the architects of that plan. What is he missing?
And proud of it, and he's missing almost everything. I just want to say one thing in terms of the numbers. Okay, up to pre-pandemic, through February of 2020, okay, the corporate tax cut had totally paid for itself and then some. The repatriation of foreign cash hit $1.5 trillion. And in terms of the overall, the $1.5 trillion, which was the static revenue cost of the bill, estimates from the Congressional Budget Office baseline showed that 1.3 or 1.4 trillion had been paid for through a combination of base broadeners and lower tax rate economic growth. So Mr. Biden is completely wrong. And if I may, Charles, one other quick point. You look at the Census Bureau numbers on income and wages. You look at the Federal Reserve Consumer Finance Survey. By far, the largest bulk of the benefits went to the blue-collar middle class and the lower middle income brackets. Unemployment hit record lows, 50-year lows across the board, including minorities. The poverty rate went down, and the inequality rate also went down. So that is Mr. Biden playing fast and loose with the numbers, presumably because he wants to completely reverse the Trump tax cuts. And that, in my opinion, would throw a total wet blanket over what is a booming economy. And, Charles, if it ain't broke, for heaven's sakes, don't fix it.
You know, and to that point, Larry, there's a Gallup poll out that says that Americans' financial satisfaction, 57% either feel it's excellent or good, and yet we keep hearing from President Biden that we're in this desperate situation that's calling for desperate actions like this, you know, $6 trillion in spending.
Yeah, well, you're right, Charles. There's a disconnect. There's no question there's a disconnect here. There has been from day one. The other disconnect is, regarding climate change, that we're in an existential threat or an existential crisis, which is complete nonsense. Among other things, emissions have been falling because of the natural gas fracking revolution. So, again, I say if it ain't broke, don't fix it. I just think you're seeing this massive government, spend. He's proposing $6 trillion in his first 100 days. $1.9 trillion has passed. And we're going to have probably another $4 trillion plus in tax increases, Charles. You've got to tell me this. Look, just from the standpoint of common sense, okay? If you increase taxes by roughly $4 trillion, that's pulling money out of people's wallets and pocketbooks. Tell me how that's going to improve the economy, would you? Just tell me that.
You know, Larry, I don't think they want to improve the economy. I think they present these things under the guise of economic policy, but I really believe what we heard last night was a reiteration of a full-throated presentation to America on why we should fundamentally change America. So it's not about economics as much as redistribution of wealth, as much as punishing those who have succeeded too much and creating this giant welfare state, which, by the way, will keep the grip, keep the grip of power by Democrats. I really think in their hearts of hearts, Larry, they look at these numbers. They're smart people. I just think that they sincerely believe we should have this giant welfare state and that the Democrats should run it.
Well, Charles, I completely agree. Everything you said. Please hold those thoughts, for a long time and keep it up. You're exactly right. Look, the left progressive wing of the Democratic Party, which seems to be in charge, always prefers redistribution over growth. That's why they have these tax hikes on the rich. The odd thing is, when you seek redistribution and you want higher taxes, you get neither redistribution nor economic growth. It doesn't work that way. We had a decline from the Trump tax cuts and deregulation and energy independence. We had a decline in so-called inequality. We had a decline, a significant decline in poverty, and we had the lowest unemployment, as I said, in 50 years. Now, that's by cutting tax rates, which boosted jobs and opportunities all across the board. Americans of every stripe and color benefited more than so in the last 20 years, right? Real wages went up enormously. During the whole Obama-Biden administration, real wages hardly moved at all. Trump beat them in 3 years what they did in 8 years. So my point is this. You want to hike taxes? You think you're going to redistribute growth? You think you're going to create, you get nothing. Nothing. You don't redistribute income. You don't get growth and job creation. What you get is a massive welfare state, which, by the way, Charles, part of the sadness here, maybe the most pernicious aspect of this policy transformation, you're right to call it a transformation, is that there's no incentives for work. None. There's no workfare. Now they're going to open up the Great Society programs, the child tax credit, etc. Work is not necessary. Now that breaks 50, 60-year link between work and benefits. You work, then we will provide benefits like the Earned Income Tax Credit. But this stuff is new. They've taken out the welfare. They've taken out the workfare, Charles. And, you know, they're reducing and eroding and demoralizing the whole dignity of work here. That's one of the problems with this central planning government welfare state idea.
Yeah, I mean, really, they're just saying they don't trust that Americans can pull themselves up by the bootstraps, and we know they can. Larry, you're the best. Always appreciate it, folks. Make sure you catch Larry at 4 p.m. Eastern Time every day right here on Fox Business. Also, be sure to check out Larry's feature in the unauthorized history of taxes. It's on Fox Nation right now, but watch it later today. Meanwhile, of course, the stock market continues to have some trouble really breaking out, right? I mean, investors responded very positively to these individual companies that posted just mind-boggling strong earnings and guidance. Now, I've always said that earnings and confident guidance are the mother's milk of rallies. For me, also, it's not just beating, right, the consensus on top and bottom line. The profit margins, these operating margins, when they widen out, that justifies higher valuations. So although we see the market now where 90% of the S&P names are higher for the year, investors are clearly cheering the big names, and they like when the big names become bigger. And by the way, having said that and just spoken to Larry, I want to remind everyone, it's a wonderful day to see these kind of numbers, just as there's a growing message that our best days are in the rearview mirror. What you are seeing with this earnings week is American excellence on full display. And it's not just these leaders of the digital revolution. It's not just the Apples and the Facebooks. I mean, this morning, one of the names born in the Industrial Revolution is still evolving, is still excelling. We're talking about Caterpillar, posted an amazing quarter. So it's a phenomenon that cannot exist anywhere else, and it certainly can't exist if we're going to punish success. These amazing feats could not happen in any country, I think, that deters investment and profits. So although the market's grinding today, you know what? It's a reminder. This is the greatest money-making machine in history. Now, the best news is everyone can participate. It's not a casino unless you make it a casino. And, of course, there are going to be up days and there are going to be down days. And you do have a chance, though, nevertheless, to become part owner of any publicly traded company, from upstarts to the biggest and best names in the world. So despite all of this amazing earnings, some of the spinning of the wheels we see on NASDAQ, I just think it's absolutely phenomenal. So people are worried right now. Is this peak earnings? Okay. People are worried about market valuations, legitimate. And then there's the inflation, the I word, really getting bigger and bigger. Joining me now, Chief Strategist for the Leuthold Group, Jim Paulsen. Jim, in your note earlier this week, you talked about, quote, the epic battle ahead. It caught my attention. U.S. policy officials just pumping unlimited money against the inflation slayers. Now, I never heard that term before. So share with the audience what these inflation slayers are, but more importantly, who's going to win this battle?
Who's going to win? Yeah. Yeah. Well, you know, I think we're worried about policy, and policy can certainly create a cyclical burst in inflation. It's already doing that, as you pointed out in the GDP report, Charles. But the real question for investors isn't about a burst of inflation, is does it persist? Is it sustainable inflation? And that really, I think, has more to do with structural forces, the inflation slayers. And people go back to the 1970s as the example of where we might be headed. But I'll tell you, the structural forces were very different back then. First off was just labor force growth. In the 1970s, the decade, labor force grew at 2.5% a year. Outside of the 1970s, the entire post-war era, the rest of the time, it's grown at about 1% per year. And the rest of the time, we haven't had sustained inflation. And we're growing probably 1% right now. We also had a young demographic in the 70s driven by baby boomers and not a lot of old people retiring. We have just the opposite situation in our demographics today, which is a disinflationary force. In addition to that, productivity grew under its average throughout the 70s. I think there's a good shot at growing above average in the next several years because of this massive technology stock rally that we just experienced in recent years. Every time that's happened in post-war history, it's been followed by a pickup in productivity. And then the competition of the United States today is far more massive than it was in the 70s when we were largely a closed economy. And finally, back then we were led by automobiles, and the tagline on that was sticker prices go up every year. Today we're led by technology. The tagline on that is sticker prices go down every year. An inflationary force in the 70s, a deflationary leader today. So I think there's decent odds that we get a burst, but not a sustained inflation in the next several years.
What about nearer term, though, Jim? The next several years, okay, we're talking. The Federal Reserve is saying we're going to get a burst over the summer, but then it's going to fade away as supply chains come back on, as some of the stimulus money runs out. I think people are concerned about does inflation bleed into next year?
I think, Charles, the odds are that probably will. I think we're going to get a burst of inflation. I think it'll be temporary, but I think it's going to be probably more severe than the Fed is selling and probably last longer than the Fed is selling. I agree with that. I think we're going to be struggling. The stock market might be struggling for a period as we head into next year with inflation numbers that just stay a little hotter than expected, like this morning's, and maybe stay hotter for longer. But I don't think it's going to end the bull. I really don't. We're going to get a correction, but if we do get a correction, I think that'll still be a buying opportunity because we're probably still in a multi-year economic expansion.
Love it. Always love these conversations, and I always learn. I love reading your work, and I appreciate when you come on and share it with the audience. Jim, thank you very much, my friend.